Welcome to the Not Old Better Show. I'm your host, Paul Vogelzang. Today's show is a great one, especially this time of year. Jordan Goodman is joining us. Jordan Goodman is known as America's Money Answers Man. Jordan Goodman is a nationally recognized expert on personal finance. He's going to answer some of our questions today about what we can do to invest, how we can juggle some of the healthcare demands and needs, and what the world will look like from an investment standpoint under President Donald Trump. Jordan Goodman is a regular guest on numerous radio and television call-in shows. He appears frequently on The View, Fox News, Fox Business News, CNN, CNBC, and CBS Evening News. Please join me in welcoming Jordan Goodman to the show. Jordan Goodman, welcome to the show. I know that you're a journalist by training. My audience knows that. We all follow you and your nationally syndicated programs. You're an author, just a one-man finance help center, among many other things. And here we are, mid-December 2016, as we kind of approach the new year, 2017. What answers do you have for us, and what are the finance questions that we should even be asking during 2017?
How to take advantage of the enormous changes that are coming. Mm-hmm. Now, you may have liked it, you may not have liked what happened in the election, but it's happened, and enormous change is coming in all areas of finance. Investing, taxes, trade, healthcare, energy. I could go through a whole bunch of them.
Well, those are
basically
all...
What happened the last 8 years is going to be reversed, is what happens.
Yeah, and those are absolutely, and I'm glad you touched on them. That's excellent foreshadowing. So let's talk about the taxes really quickly.
Sure.
President-elect Trump has promised to simplify the tax code and shield maybe the middle-class bank accounts from the IRS. Who are going to be the winners and losers in President Trump's plan kind of coming forward?
Well, the unusual thing about his situation is he has a Republican Congress, both House and Senate, to actually enact these things. President Obama had a Democratic Congress only for the first 2 years of his administration, during which he got through Obamacare and Dodd-Frank. And basically, the last 6 years, he's gotten nothing through. Everything he did was by executive order, and all those executive orders are going to be repealed on day one. So it's a very different situation in that Trump is going to be able to get through what he wants to. So on taxes, they're going to cut corporate rates from currently 35% down to, now he's talking about 15%. It might end up being a little bit higher than that, but maybe 15 to 20%, which not only affects big corporations, but probably a lot of your listeners are small companies or even sole proprietorships or subchapter S companies. That's going to make a huge difference to be able to keep a lot more of your profits, which you'd be able to use to reinvest, buy back stock, do all kinds of things, open new stores. So on the corporate side, and also overseas, there's about $2.5 trillion worth of money parked overseas that doesn't want to come here because of that high tax rate. They'll probably have some kind of a tax holiday, maybe give them a 10% tax. So you could literally have trillions of dollars coming back from overseas, invested in the U.S. businesses. So that's going to be very positive as well. So that's on the corporate side. On the individual side, you're going to cut the current 7 tax rates down to 3, probably 33, 28, and 12, subject to negotiation, but something like that. And I mean, people talk about simplification. I have to see if it actually happens. But even going from 7 brackets to 3 itself would be a big change. Again, putting more money into people's pockets. So the whole idea of both corporate and individual tax returns or reform is to put money into the private sector instead of keeping in the public sector. And in general, that stimulates a lot of economic growth. So we'll have to see, but that's basically what's going to happen in taxes.
And so my audience will remember well Kennedy, Reagan, Bush. They all were focused on tax cuts to a certain extent, and tax cuts actually helped. They helped the economy. They really
every time. Yeah, under Kennedy in 1962, he cut rates. It's hard to believe at the time, but the marginal rate was 91%, and he cut it to a mere 70%. But that did cause the economy to do very well in the 60s. Then Reagan, as you say, cut rates in 1982. Capital gains went down to 28% from 50% at the time. And then Clinton cut rates in 1997 the capital gains rate went from 28 to 20, and that caused the internet boom, basically financed the internet boom. And then Bush in 2003 cut rates down to 15% on capital gains, and other rates came down as well. And that caused the boom from 2003 to 2007. So every time rates come down, there's more economic activity, and the government actually gets more revenues. So the idea behind this is by stimulating the economy, if we can get 5-6% growth instead of 2% growth, that produces a lot of revenue for the government. And in theory, it so-called pays for itself, meaning the government gets more revenues because there's more economic activity. Let's hope it works out that way, but that's certainly the idea.
Yeah, we're certainly hoping for that. This kind of idea that Peter Navarro talks about, doubling the growth rate. Those are only going to be good things, likely, and we'll certainly see. But everywhere we look today, whether it's the media, the various publications talking about this 55 plus age community, kind of my age group, our age group, we're entering businesses right and left.
Right,
and
right.
So it might not be corporate tax rates, but it could be the sole props, as you mentioned. So let's talk for a second about small business lending.
It's been very, very tight. One of the things that could spur growth, I'm not saying eliminate Dodd-Frank, but loosen it up to some extent.
Mm-hmm.
The bill itself was passed in 2010. The bill was 2,000 pages. Okay.
Yeah.
That has promulgated over 100,000 pages of regulations, basically telling the banks never take any risk on anybody for the rest of human existence. Basically, give all the money you want to AT&T and Exxon, but Joe Main Street store opener, forget it basically because he's too risky. So that has slowed the economy a lot, and loosening that up. I'm not saying to do wild lending to people who are never going to pay it back, as happened in the mid 2000s, but I am saying if you have perfectly creditworthy people, both small businesses and individuals, they should be getting loans in a much easier way than they are today. It's really, really hard to get a small business loan. You have to go through tremendous paperwork and proof, all kinds of things. And the same is true for individuals getting mortgages, for example. And I think there's lots of perfectly middle-class, creditworthy, responsible people who can't get mortgages these days and can't get small business loans because of all these regulations. So that will spur growth itself. I always like to give specific practical details, if that's all right with you, Paul.
Of course. Yeah, absolutely, Jordan.
So in the case of small businesses, here's a website that can help people get small business loans. It's corporatelendingsolutions.com.
Good. We'll put up a link.
Corporatelendingsolutions.com. They've also got a phone number, 877-290-2510. And what they do is they hook into a whole community of people who want to lend to small businesses, not traditional banks. Could be hedge funds, could be individuals, could be institutions. Small business lending can be very profitable. And so you don't have to just go to the local bank and have them reject you and that's it. There's a whole other world out there, and they can kind of connect you to ways for small businesses to get loans that might not otherwise be possible.
That's very helpful to know, Jordan, because my audience, they're likely going to be able to pass muster on the credit score. They're likely going to have a credit history that's going to be significant, but they might not necessarily pay attention to this option of an online lender.
Right.
How has that changed, and what can people expect from an online lender? Is that a completely different kettle of fish then?
There are some good ones and bad ones. Okay, the ones I just mentioned, Corporate Lending Solutions, are good ones because they have legitimate sources of funding. The bad ones are what are called merchant cash advance companies, and you see them all over the place, and you get solicitations for them over the place. They take a piece of your credit card transactions. They actually do your credit card processing and take a fee for that. Very, very, very high interest rates, 40, 50%, something like that. Mm-hmm. And so it's what I call payday lending for businesses, basically. And it gets you on this treadmill you can't get off of. So particularly if you're a struggling small business, I would try, if possible, to avoid merchant cash advance places that are predators. I think that's the word I was looking for. And get legitimate. And I mean, the one I'm talking about, Corporate Lending Solutions, they may be like 6, 7, 8%, much more reasonable rates.
Well, we'll put up a link, of course, to that. We'll put up a link to the resources that are on your page. Of course, we're talking to Jordan Goodman, who's a finance expert, and we are mid-December. 2016, 2017 is coming fast, and so I know you're very busy this time of year, Jordan, and we certainly appreciate the time.
Sure.
So let's move on to the subject of real estate. Now, my audience, we're not necessarily going to be first-time home buyers, but we might be sellers and we might be interested in refinancing. We might
Sure.
have significant home equity. What advice do you offer about the subject of mortgages, the subject of reverse mortgages, and other home equity type programs?
All right. So the mortgage market has changed dramatically recently. We've pretty much had very low interest rates for a long time. The 30-year fixed rate mortgage had gotten down to about 3.5%. The 15-year mortgage down to about 2.5% before the election. Since the election, they've shot up dramatically, one of the biggest increases we've ever seen in a short period of time. With the 30-year, which was 3.5, is now maybe 4.5 or even higher.
Mm-hmm.
The 15-year had been 2.5, is now 3.5 or higher. So, I mean, historically, these are still low rates, but they've moved up a lot. So if your current mortgage is, I would say, 5% or higher, of which there's still a lot of people in that camp, then it makes sense to refinance or at least look into it before the window closes. I mean, I think we're at 4.5 on 30-year fixed. That could go up to 5% or higher. A website that can help people do that is You Can Refi, YOU-REFI.com. And the mortgage that they do, which is the one I've had for many years, is what's called the ARC loan, the automatic rate cut loan. Their website, arcloan.com. When rates come down, your rate automatically goes down. Every quarter, they take a look if rates have come down by a quarter or more, it automatically goes down. But when rates go up, it does not go up. So my ARC loan originally, which I took out in 2001, and I think it was about 10% at the time, has come down many, many times. It's now about 3%. And when rates are going up now, it does not go up. And each time it adjusts down, you do not change the maturity date, right? So you're not starting a new 30-year clock all over again. So my original mortgage of 2001 matures 2031. Even though it's come down about 7 times, the maturity date is still 2031. So you get a lower payment and you're not restarting the clock. The problem with most people's refinances is they keep starting the clock all over again. Yes, they get a lower rate, they get a lower payment, but you just threw away all the interest you've been paying because remember, in a mortgage, all the interest is upfront loaded. So that's a little tip on refinancing. Another strategy in the mortgage area is called mortgage equity optimization. And that literally allows you to pay your mortgage off in about 5 to 7 years instead of 30 years on the same level of income you've got today. And this is something you will never hear about from a bank because they do not want you to pay your mortgage off fast. The slower, the better. And even better for a bank is refinancing and start a new 30-year clock all over again. A website to find out about mortgage optimization is truthinequity.com, truthinequity.com. And let me just briefly describe how it works. You use a home equity line of credit, a HELOC as they call it, which is a liquid line against your house. It becomes your checking account in effect. You keep your money, which normally is sitting in a checking account or a savings account earning 0, in the HELOC. A HELOC is a liquid line, so you're pushing your balance down every day by having your money sitting there instead of in the checking account. And then you use bulk amounts from the HELOC to pay down your first, and the end result is you're making a lot of progress every day in paying your mortgage down instead of making almost no progress once a month with the traditional system. Does that make sense?
That makes sense. That is really helpful to hear. These are great tips. This is Jordan Goodman. He is well known as America's Money Answers Man, and those were just some fantastic answers. And again, lots of resources. We'll put up links on the subject of real estate, but having to do a little bit more with investing.
Yes.
What are you suggesting as great places to invest as a result of presidential election?
Real estate, if you do it right, can be a great way to have stable income without market fluctuation. Okay. A specific thing that I'm doing and I'm involved in myself is what's called a commercial real estate income fund. And there's a website for that too, commercialrealestateincomefunds.com. It's a way of earning 8% on an annual basis, paid monthly. You can either take the checks into your checking account or reinvest them automatically. And then every quarter, you get a profit sharing distribution as well, which could be another 1 or 2%. So it's a total of like 9, 10%, very, very safely. There is no market fluctuation. Minimum hold time is 18 months. Minimum investment size, $5,000. So it's pretty accessible to a lot of people. And what they're doing is they're lending money to high-quality commercial real estate projects that use it to renovate or improve their property over a 1-year period, typically, something like that. It could be apartment buildings, shopping centers, medical buildings, all kinds of commercial properties. We talked earlier about Dodd-Frank. This is kind of an outgrowth of that because these places that want to improve their properties can't get loans from banks, So they go to a fund like this to get their financing. And what's unusual is they're willing to give up some of the profits when the building is sold to the fund, and that's the profit sharing we talked about. Let me just give you a recent example, Paul, of what just happened.
Yeah.
So there was a guy that had a big house in a college town. I think it was in Boulder, Colorado, and he was renting it out to 2 students. He said, okay, if I can renovate this, I can earn more from it. So he got a loan from the fund, completely renovated the house, and made 4 apartments instead of 2 from the same house. So now he put in 4 bathrooms, 4 kitchens, 4 doors. A year later, he has double the income from the same property because he now has 4 incomes instead of 2 from the same. So the value of the property went up dramatically. He sold it and shared some of the profit with the fund, which goes to you, the shareholder. So the guy he's absolutely going to make money at this. He knows he's going to be able to rent it out to 4 instead of 2 afterwards. So the default rate is almost non-existent in these things. So it's very secure. The maximum that they lend is 70% of the value of the property. So there's a big cushion, what I call the equity cushion there. So the builder-developer has every reason in the world to complete the project because they know it's going to be profitable for them. So there's a way to get 8% super safely, no commissions whatsoever, 100% of what you invest goes in there, in an environment where otherwise you're going to get 0 in the CDs and money market funds at the bank, and long bonds maybe 2%. With the possibility, I would say the likelihood of capital loss. I mean, long treasuries since the election have gone up from about 1.5 to 2.5, meaning you've had capital losses of 10 to 20%. Here you're getting 8% with no market fluctuation, so no capital losses, and you can do it inside an IRA or outside an IRA. So there's a place to invest in real estate for income, and it's completely passive. You don't have to do anything. You just write them a check, and checks start coming in. So that's the way it works. So again, if that helps anybody, commercial real estate income funds.com. They've also got a phone number, 888-444-2102.
Excellent resources. That's just fascinating, Jordan. Just got 2 more questions for you. Again, I know you're very busy this time of year, and I want to shift gears for just a second and talk about maybe a little bit more of a difficult subject. I think it's still on everybody's mind, and that's terrorism. And as we watch all of these events unfold, we're horrified, yet we don't often hear about the impact on the economy. I know you really do focus on some of these subjects. So talk to us a little bit about, how are people going to react? How's the stock market going to react? Are we going to start to get, negative interest rates? And what about consumer confidence? There's just a whole bunch of things that come into this area once terrorism kind of strikes.
Well, we've had a lot of terrorist incidents recently. Certainly during 2016, we had a ton of them. And it makes people freeze, basically. It makes people not want to spend, not want to invest, lowers consumer confidence. Although I must say we've had so many terrorist incidents lately that people are starting to get a little numb to it, unfortunately. I mean, we had the terrorist incident in Germany recently, and we had somebody assassinated in Turkey. I could go through all these things. And yet the stock market keeps hitting all-time highs. This year we had San Bernardino. I won't go through all of them, but we've had a lot of terrorist incidents, and yet consumer confidence is at an all-time record high. The stock market has been soaring. So to some extent, we're kind of getting used to it a little bit here. When that bomb went off and the truck went off in Berlin and killed a lot of people, I mean, it puts the nation into mourning, and people don't want to invest and they don't want to spend. It makes people very cautious about that. I'm actually doing a book on this, which is going to be coming out next year, which the title is Investing in the Era of Terror. This is something I'm spending a lot of time at, because basically what I'm saying is, yes, these are horrible things, but you shouldn't get frozen, and there's still lots of good things you can invest in, no matter how many things are blowing up around the world.
Well, we will have you back to talk about that book. I know that's going to be of interest to my audience. Okay, last question, also of real interest to my audience, and that has to do with health insurance. Always front and center. Likely to undergo some significant changes in the Trump administration. So what changes are you focused on, and what are most likely to occur? How should we position ourselves and our pocketbooks to either kind of take the hit or take advantage?
Dramatic changes coming in health insurance, indeed. I mean, we know that on day one, President Trump at the time is going to repeal Obamacare. Now, we don't know what that means because we don't know what Plan B is, but it's going to be repealed, and then they're going to have to figure out how to replace it over the next year or so. It's going to be very complex because this has been in law now since 2010. So we've had 6 years for people to kind of get used to this, and the healthcare system to get used to it, insurance companies to get used to it. There's been some good things. We've had over 20 million people get insurance that did not have it before. The amount of uninsured are the lowest ever, so that's a good thing. But the premiums have gone up super dramatically and making it unaffordable for people. And also for businesses, once you hit 50 employees, you have to cover your entire workforce. So a lot of businesses get up to 49 employees and say, I'm not hiring one more person. So it's been a kind of restriction on growth, and that will be released to some extent as well.
Mm-hmm.
What's going to happen next? Here's my guess. We're going to kind of go back to an older system to some extent, meaning you're going to be paying premiums to the insurance companies that should be lower, and then the people that have huge expenses will be put into what's called a risk pool. We used to have these things. Each state will have a risk pool. So somebody who's got huge expenses and so on will kind of be put there, and therefore everybody else's premiums would be able to come down, because right now you are paying these high premiums to cover all these very expensive people. The whole premise behind Obamacare from the beginning was you were going to have these young, healthy people join the system, sometimes through mandate, and their premiums were going to finance the older, sicker people. So what happened is the older, sicker people joined. That's the 20 million. The younger, healthy people did not join for the most part because the penalties were far less than the premiums. So I said, all right, so I'll pay the $600 penalty, but I don't have to pay premiums I can't afford all year. So that's where it kind of broke down, and that's why the premiums went up so dramatically, because they had all these healthcare costs from the older, sicker people without the subsidy from the younger, healthy ones. And that's when you're seeing these premium increases that have been dramatic. As of January 1st, I think the worst is Arizona. It's up 116% this year. Mm-hmm. Tennessee, 64%. Lots of places with dramatic premium increases that people just can't afford. So they're going to be dropping health insurance if they can't afford it. So the whole system has not worked the way it was supposed to work. And it'll be a major change. The person who's going to be coming in as Health and Human Services is Representative Tom Price from Georgia, who's been the leading critic of Obamacare. And his job is to pull the whole thing apart and do something new. So health savings accounts will be part of it. Competition across state lines will, in theory, be part of it. But we really don't know exactly what's going to replace Obamacare. But it's going to be a completely new world in healthcare going forward.
Well, Jordan Goodman, thank you so much for joining us today. Of course, Jordan Goodman is the host of the Money Answers Show. He is America's Money Answers man. You can find him all over media, Fox News, CNN, CNBC, CBS Evening News. Jordan, give us your website address again real quick.
So my website is moneyanswers.com. Glad to take emails from your listeners as well. And there's all kinds of resources. I've just given you a small number of them, but websites, links, videos of all types to help people in every aspect of personal finance. So it's been a pleasure to be on your show.
Yes, what a pleasure it's been for us too. Credible, honest, just really knowledgeable answers and resources. Thank you, Jordan Goodman, for joining us. Have a great 2017 and Happy New Year to you and your family.
Thank you, Paul.
Thanks, Jordan. Again, my thanks to Jordan Goodman. Of course, we can find Jordan at moneyanswers.com. We're going to put up links to all the sites as well as phone numbers that Jordan mentioned, corporate lending solutions, you can refi, commercial real estate income funds. So thanks to Jordan Goodman, my guest today. I think as 2017 approaches, we need to be mindful of all of these things. Jordan, thanks again for sharing all of this wonderful information with us.